So this video, we're going to look at subsection 2, looking at associates and joint ventures and joint operations, making sure you guys can understand and interpret that information. So again, I'm just going to share my screen, making sure you are familiar with what you need to do. So if we go back to where we're at, we're going to go to our section D, associates and joint arrangements, and go into that part specifically. And the first one I'm going to look at is associates and joint ventures. So while we're waiting for that to open up, remember now, an associate or a joint venture, a separate entity type, it's something completely different than a subsidiary, and we need to understand how that works. And we're going to go through that, making sure we know what you guys are expected to be able to account for. So also this in chapter 11 still. So within chapter 11, you will see there's a part looking at the end of the day subsidiaries, and then we get to associates. So please go back to chapter 11, making sure you understand the part of associates. So the part specifically linking to associates, just want to get this now. You will see is, like we already said in the first part of our video for our first section, you need to be able to identify an associate, discuss and apply the equity method for an associate. Okay. So make sure you need to understand that's the focus of an associate. So that's what we're going to focus on for this specific section, making sure you understand what you need to be able to do. So if we have a look at what we need to understand is we're going to look at associates and joint ventures, and we need to know that we're going to look at the equity method and account for that. Now my mouse is just giving me a bit of issues here. So very important for you to understand what we've already discussed in the first section. We looked at the subsidiary. In a subsidiary, I'm considered a parent subsidiary regardless my percentage shareholding if I have control. And remember, control is addressed within IFRS 10. So I need to understand that definition of control, be able to apply it. And when I have control, I will then consolidate. And what do I consolidate? My equity share. So let's say I have a 60% share and I have control. I will consolidate 60%, meaning 100% will come in, and I will create non-controlling interest for 40%. Or like in that one question where we had our 40% share, I'm able to appoint and resign my key management personnel, and the other shareholding is held by a lot of other entities, which is very small, their shareholding. And now we see that I have control. Even though I have 40%, I will consolidate, but now 40% will be consolidated, and that means I will create non-controlling interest 60%. Okay. For an associate, you need to see we're looking at significant influence. So again, there's a definition of significant influence. So significant influence tell me I have the power to participate in the financial and operating decisions of the investee. It is not control or joint control over their policies. Okay. So remember, the other one says I have the power to direct financial and operating policies based on what I have, and then based on that, I have a right to a variable return, and because of my involvement, I can affect that variable return. That's control. So significant influence tells you I can only participate. Okay. So that's the main thing you need to see with significant influence. I can participate in my financial and operating policy decisions. And then they tell me the following might show this to you if I have representation on the board. So part of your discussion of significant influence will be these items. So if I can represent a director on the board, I have significant influence. If I can participate in my policy making process, I have significant influence. If I have material transactions between my entity and the investee, meaning the parent and the associate, if there's material transactions, so let's say 80% of my transactions is with you and the other 20 is with an outside party, that's at the end of the day significant influence. Or if we interchange managerial personnel, or I provide you with essential technical services, that all is an indication of significant influence. Okay. Normally, It's when there's 20% or more, but that will be if I don't give you any information about this. The moment I give you information, if one of this applies, so only one of that needs to be applicable, then there's significant increase. So it's not all of them, only one. Okay. Otherwise, you're going to look at 20% or more. And then we need to know, for an associate, we apply the equity method. Equity method means I account for my investment at cost plus growth. So what does that mean? I will have my cost, which I initially paid. I don't add their financial statements into my financial statements, in the consolidated financial statements. It will be the parent's sole financial statements. And I will have now two items which I need to include with a third one, but two specific items which I need to see. And I'm just going to write it over here. So in the statement of profit and loss, I'm just going to change the color here so that you guys can see it a bit clearer. So in the statement of profit and loss, I will have my share in profit of associate. So that's one item that will come into my consolidated statement of profit and loss. One line item after tax effect. Then in my statement of financial position, I will have one item, my investment in my associate. And that is now my cost plus my growth. And then in the statement of change in equity, included in retained earnings. Why do I say included? It will be the parent plus my growth of the associate, which I included in there. So those are the items that I will have in the consolidated financial statements if I am an associate. So please make sure that the process of preparing my group financial statements when I'm an associate is completely different than a subsidiary. So make sure you are familiar with this process. Go and revise it. Make sure you come and ask the questions if there's something that's unclear, so that we are able to account for this and make sure you are able to get decent marks for when there's an associate asked specific. So bottom line, it will be the parent, all their items, and I will have one item, profit share in associate. And I just want to mention that the bottom line, without thinking about intergroup transactions, I will take the associate's profit for the year and I will multiply it by my percentage share, and that will be my profit share in associate. The retained earnings will be the parent part plus, what do I mean by growth in associate? I will see what was my retained earnings at the date I acquired my share, what's my retained earnings at the beginning of the year. That growth I will multiply by my percentage share, and that I will include with the parent's retained earnings. Okay, opening balance. And then my investment will be what I paid, plus that growth for the retained earnings, plus the share in profit, less a dividend that was paid, my share that I received, and I will get my investment. So make sure you guys understand that whole flow at the end with my associate. So please go and study work through part 4.1.3 for intergroup transactions. Again, here, I want you to focus, make sure you understand the impact of deferred tax on this, okay? And also make sure that it's important to know who sells to, if the parent sells to the associate or the associate sells to the parent. And the reason for this is, remember, they will be accounted for differently. Because I'm not consolidated, I don't have 100% like I have with the subsidiary, and I can take out sales for the subsidiary or take out sales for the parent. I only now have one line item, which we said in the statement of profit and loss, my profit share or share in profit in associate. One line item in the statement of financial position, my investment in associate. So make sure you understand that part, work through those intergroup transactions, go and consult that in IAS 28, and please make sure that you come and ask if there's something that's unclear. Okay. So the next one, this is also something that's different now if you add the old textbook. So this illustration is asked a little bit differently. So the first two is now added explanations and then the calculations. I'm going to go through the explanations as well, making sure you understand that and that you are familiar with what needs to happen with that. Okay. So we will see that I acquired a 60% shareholding for 6.1 million. When my retained earnings of the subsidiary was 3.6 million, retained earnings was 10.6 million, and since acquisition, there has been no impairment. So they talk about the parent subsidiary shareholding. Just give me a second again, guys. Okay. So the next part is where the associate now comes in. So they tell me I acquired a 30% equity share in Undersco, and at the date they told me that their retained earnings was 6.2 million. I paid 4.1 million for my share. The retained earnings at the end of the year is a 9.2 million, and it is able to appoint 1 of 5 directors on the board. So there I can see I have representation on the board. So I know that I am, at the end of the day, I have significant influence with that 30%. So I know that I am an associate. They should also tell me about impairment test. It was done for the others. So there's an impairment of 500,000 of my investment, which I had. Right. And then they tell me during the year, Anders also sold goods to Ping of 3 million. And they tell me the profit margin was 20%, and 1/3 of these goods remained in inventory at year end. The retained earnings of Ping, 41.6 million. And now they tell me, explain why equity accounting is the appropriate treatment of Anders in the consolidated financial statements, and briefly explain how the equity method would apply. Right? So let's have a look at that one first. And I'm just going to take out all the highlights so it doesn't affect what we see. So first of all, because I hold 20% or more, normally it shows that I have significant influence, unless I can clearly demonstrate that that's not the case. So I start off with that assumption, the 20%. So I will mention that. And then I tell them, the significant influence is usually evident by representation on the board, and I will tell them that I now have representation on the board because I can appoint 1 director out of the 5, and I also have 30% equity share. So based on that, I now have significant influence and not control, because of that, I can be classified as an associate, and the equity method works as follows. It will be recognized at cost, adjusted for my share of post-acquisition change in my net assets, and the profit and loss included in the for my share being a P&L and other comprehensive income as a profit share in associate, which I need to be able to account. And that's what I've mentioned here. So can you guys see here that we don't go into detail of now giving, according to IAS 28, the definition. In our discussion, we apply what the definition would have said, saying it's 20% or representation on the board. So I don't give them that whole definition of all of those items like we are used to, as we would have done pre-grad or in our honors years or CTA years. We basically go and apply what's applicable in the question to our definition and have that discussion once off. So if this is too complex to adjust, because you might still consider doing some other examinations as well, remember, I cannot mark it wrong if you give me more information. So if you gave me the definition according to IAS 28, it will take time. And then to apply that, it will take time. So can you see that we get to the bottom line? So the bottom line is what I want, and see that you can apply the bottom line. But if you give me more detail, that will also be correct. So I will not deduct marks because you gave me the definition of significant influence according to IAS 28. So if you do that, that's perfectly fine. But you will not get a mark for that definition at the end of the day. You will only get a mark for applying what's relevant in the question. Happy? Does that make sense to you guys?
Yes, it does. Thank you.
Okay, So the next explanation, they also tell me with reference to the underlying accounting principles, the accounting treatment required to consolidate the financial statements for the trading between Ping and Anders should provide a journal entry for any consolidation adjustment required. So they want me to explain how I will treat this sale that took place. Okay. And now it's important to follow or understand the following. Because there's not control, I'm not part of the same group. I'm not seen as one. So it doesn't mean that my transaction needs to be eliminated. So remember, if I am a parent subsidiary, I cannot transact with myself, so I couldn't have sold the infantry. So therefore, we would have said if there was sales, reverse or take out the total sales with the parent subsidiary, and then take out unrealized profit because I'm seen as one. But with an associate, I only need to take out unrealized profit between the company where I now have included 20% of those items. So have a look at what they try and explain to me. I need to now, at the end of the day, take out the group share of profit and eliminate the part that's remaining within the group inventory and the unrealized part adjusted through the sale. And now it depends on who sold to who. And I want you to quickly listen and make sure you follow what I try and explain here. Okay. So they clearly tell me here, Anders, the associate, sold. Okay. So my question is, who makes the profit? Who makes the profit? So what do you guys think? If Anders, the associate, sells to the parent, who makes the profit that's unrealized?
The associate.
You guys all agree it's the associate?
Yes.
So, do you agree with me if we think about it, and I don't want to confuse you by talking about parent subsidiary, but I want you to see the difference. Can you see that if it was a parent subsidiary, we would have said, seen as one entity, take out the full transaction. So that full sales, the 3 million, take out sales, cost of sales. And because the parent and the subsidiary was 100% included, it didn't matter whose sales are addressed because I will take out sales regardless who sold to who. And there's inventory, parent and subsidiary in there, so it doesn't matter. So the direction of the journal doesn't make, or that doesn't differ depending on who sells to who if it's a parent subsidiary. But because I'm now an associate, for Anders, can you see that the only item that I will have in the statement of profit and loss will be profit or share in profit in associate. And the only item that I will have for him in the statement of financial position will be investment in associate. Is that clear before I go further? Okay. So if Anders only have profit share or share in profit in associate, if they make the profit, can you see that total sales, the 3 million, I don't need to do a single thing with it because I'm not seen as one. I am allowed to sell to one another. But the only part I now need to take out is the unrealized profit, 20% of the 1/3 that's left. Okay. And now it's important for me to see, because the associate sold, that will now lie within, at the end of the day, their profit share. And the parent has the inventory left, so I will take out the inventory part, the 60,000 from the parent. So if we have a look here, my journal will look as follows. Debit, the share of profit in associate, 60,000, credit inventory. So can you see it looks different than what a parent subsidiary would have been? You guys happy with that?
Yes, thank you.
Okay, so I want you to just add a note and say, let's now pretend it was the other way around. So let's say Ping sold to Anders. How will this now be different? Do you agree with me the calculation that we do to get you the 60,000 profit margin will be the same thing? 20% profit margin, 1/3 left, and I have a 50% share, so I will still have unrealized profit of 60,000. You guys happy with that calculation?
Yes.
So now my question is, how will the journal look if the parent made a sale? Who has the sale?
The parent.
And profits.
Okay. So can you see that the parent can't recognize the profit on the sale of inventory? So how do we normally account for profit on inventory? think about it. Thinking about your own financial statements. How do you account for when you sell inventory? What's the transaction that you normally account for? What does IAS 2 tell me?
Debit cost of sales, credit inventory.
And with that?
Revenue and whether it's on credit or cash.
Okay.
Credit revenue, debit bank or account receivable.
Okay, cool. So can you see now that that's where the profit lies for the parent? So to take this out, I will need to go and say, wait, for the parent, I need to go and say debit revenue, or go and say credit my cost of sales, and then the credit is now lying within the item, it's inventory. But think about it, for the associate, do I have inventory of the associate in my consolidated financial statements? What did we say? We have one item, investment in associate. So now that goes to my investment in associate, the 60,000. Let me just do it as follows. Okay, so that's the profit. So I need to now see if I go and work on the total sales being a third, it will be 1 million. So just quickly do the calculation with me and see if you get this as well. So for sales, instead of looking at the profit, I will take the 3 million and say of the 3 million, there's still 1/3 left. So divided by 3 gives me 1 million times 30% tells me that it is revenue is supposed to decrease by 300,000. And then cost of sales is supposed to decrease by 240, being now 80% of that because the profit is the 20% that I have. And this is the journal I will account for if the parent made a sale for closing inventory. Can you see it looks completely different to one another? And the reason is the items that I have for the associate when the associate sale is profit share and associate, and I have the inventory in the parent's books. But if the parent sale, it's the parent's items of profit, which is the revenue and cost of sales, which I need to correct respectively in the correct items. And then where does the item now lie that was sold? It's in the statement of financial position, and the only item I have for the associate is the investment in associate. So I hope that makes sense. Okay. Happy with that? So if you guys have a question about that specifically, please don't hesitate to send me a WhatsApp on the group so that we can discuss that in detail, making sure you understand that for the associate, it depends on who sells to who, and that will derive or tell me how to write my journals at the end of the day. Okay. So then if we go further, in the question, they ask us to calculate now the investment in associates. So I'm just going to show you, remember what we've paid. We start off with what we paid. We said we paid at the end of the day 4.1 million. So we start with our cost, 4.1 million. Then we have our growth in retained earnings. When we initially acquired our share, retained earnings was 6.2 million, now at 9.2. So there's a growth of 3 million. Times 30%, so 900,000 will be included. And then there was an impairment of 500,000, which they told me, so I will deduct the 500,000. So there's my investment in associate, okay? And make sure you guys understand that if the parent sold, remember we would have had a journal saying credit investment in associate for that last part, then I would have deducted that part still here for the unearned profit within that sales of the transaction if the parent made the sale. So this is how it will look if the subsidiary had a sale. The parent made a sale, remember the 60,000 will now be deducted here as well. And now my investment will be a 4,440. And next year when I realize that now it will all of a sudden become more and my investment will be at exactly the same place as with the 4.5 million. And then the next part that they ask is to show the retained earnings. So I have my parent, my subsidiary. I'm not going to go into too much details. My associate, we have that 3,000. And remember now, that's the share of my pre and post acquisition profits, and I just show you here that that's the subsidiary and that's the associate that I have, and they have the impairment loss, and now I have my consolidated retained earnings. So make sure you see how it follows through. 100% of that will be included, and then I create 40% non-controlling interest. So that's what ended up for the parent, and for the associate, I only include 30% to get to the 900,000 and deduct then that impairment. So based on fair values, you guys can work through this part for goodwill, the fair values and the measurement periods for my consideration transferred, etc. This is back to IFRS 3, so you can work through this part, the fair values, so that you understand it. And please work through this transaction, this part of the consideration, not something difficult. Again, it reflects back to IFRS 3 so that you can follow what did you pay, and that payment will now be my investment, which I initially started with. So you can work through all of that, and you can see that there's guidance in IFRS 13, which you should have done in chapter 4, or still will do in chapter 4. So I just give you a little bit of guidance, making sure you understand fair value is also applicable with each groups. And then work through activity 5 again for this chapter, and go and look at question 6 and question 14A2 for associates or joint ventures. Okay. So just want to, before I move on to the next part, make sure you guys understand the following. If I am a joint venture, and that will now be applicable in the next section, I also account the equity method. So now, instead of having my share in profit of associate or my investment in associate, it will be share of profit of joint venture or my investment in joint venture. So exactly the same thing, but a classification happens under a different standard. But when we account for it, it's also accounted for under IAS 28 joint ventures. Okay, you guys happy with that? So the last part of today's session, we're going to look at joint arrangements and make sure you guys understand what we need to be able to account here. Just want to make sure, can you guys still see now the screen where the purple is for chapter 15?
Yes, we can.
Okay. So what is expected of you? You should be able to apply and discuss joint control and apply and classify joint arrangements, which is either joint venture or joint operation, and then prepare financial statements for the joint arrangements, either joint venture or joint operation. Right. So here you need to see we have definitions. A joint arrangement, I need to see that it's arrangement where 2 or more parties have control. So I just want to explain this so that you understand the difference between this and our previous example, which we started with subsidiaries in the very first section, where we had a 40% share and 5% share was held by different entities across board and they couldn't work together. So let's change that. Let's now say that there's 3 entities and they have joint control, and I tell you, I have a 40% share and each one of the other 2 entities has a 30% and a 30% share. Now I need to see whether it's control or joint control. And joint control will tell me, I will tell you that there's joint control. And joint control will also tell you that it's an agreement which they need to have unanimous consent at the end of the day. So now, to make sure you understand that there's joint control in that question, I will tell you, to change anything, I need to have all 3 entities agree on the shareholders meeting that they will change something about the business activities, whatever the case might be. All 3 of them needs to unanimously agree on what needs to happen. That is now joint control. So to get to a joint arrangement first, I need to assess the definition of joint control. Joint control, yes, there's a joint arrangement if there's joint control with these 3 entities. So let's change that up and say now, we still have those 3 entities, a 40, a 50, and a 30. And I tell you, at the end of the day, at the shareholders meeting, 2/3 need to have consent to change activities. Can you see it's not unanimous? Then it's not joint control. And now we're back at considering whether it's significant influence or whether it might be control according to IFRS 10. But the moment we say everyone, all 3 of those shareholders need to unanimously decide, then we have joint control. Is that clear? Can you see the difference there between control and joint control?
Yes, we can.
Good. And then once we conclude now that there's a joint arrangement, I then need to see that there's two types, a joint operation and a joint venture. Now, a joint operation, you need to see that I have rights to assets and obligations relating to the agreement. And a joint venture, I have the right to the net assets. And I'm just going to make sure you understand this in a bit clearer part on this diagram. So if the arrangement is structured through a separate vehicle, okay? If it's structured through a separate vehicle, it will be a joint venture at the end of the day if I have the right to the net assets, meaning I have an equity share, okay? If it's not a separate vehicle, but it's an agreement that I have, and there's no equity share that I have, but we still have unanimous consent that we need to give, and we have that joint control, it's then a joint operation. So when it's a joint venture, we equity account under IAS 28. So it's that investment in joint venture and share in profit in joint venture. If not, it's a joint operation at the end of the day. In the joint operation, I will, on a line-by-line basis, proportionate consolidate, meaning if I have a 40% share, I will bring 40% of all my assets and liabilities into my consolidated financial statements, and the same with my income and expense. But you need to see that this account for the joint operation in essence happens in the separate financial statements, not in the consolidated. Yes, it will end up there in the consolidated financial statements, but it happens in the parents' separate financial statements when I account for the assets and liabilities. Okay. So just to explain that, I'm going to show you the difference between a separate vehicle or separate entity and not. So have a look at this first activity. ABM Mining entered into an arrangement with other entities, Delta Extractive Industries and national government, to extract coal from a surface mine. Under the terms, each of the two entities is entitled to 40% of the income of the coal, and the remainder will be allocated to government. So let's just stop there quickly. Can you see that there's 3 entities involved here, but they don't have a separate new entity through which they do their activities? ABM and Delta will mine, they will sell, and they will add it together from that surface mine, all the income, and they will then distribute it 40% to each one of them and 20% to government, and there's no separate entity in here, okay? To confirm that, they also tell me the machinery needed, ABM and Delta will purchase themselves. Cost to repair them and keep them active, they will, at the end of the day, share in the same proportion as income. Coal that's left will also be on the same proportion, and any decision that must be made unanimously needs to be agreed by all 3 parties. So can you see that there's no separate entity created for this specific? So the moment this happens, it is now at the end of the day a joint operation. It cannot be a joint venture because there's no equity share here. So now at the end of the day, I need to account for all the assets and liabilities in my books, all the income, all the expenditure. If I told you here that they formed a 4th entity and they created that 4th entity, and then I tell you now that 4th entity is entitled to now or to make sure that they pay for the repairs, they need to acquire the machinery, but then separately they will allocate the profits to each one of them 40-40, 20 at the end of the day. Then I need to see that that's now a joint venture and I account for it as a joint venture. Or if I told you it was a separate entity, but all of the criteria like this remain the same, because of the joint or the separate entity not being responsible to pay any expenses or to incur anything on itself, and each one of the entities still need to do it, it's still a joint operation. So you just need to work through that a little bit. Go and look at IFRS 11, work through it again, make sure you understand that classification. Okay. So for this question, they ask us, how will we account for the arrangement during the first accounting period? So now they tell me in the first accounting period, ABM mined 460 tons and they sold it for $120 per ton, and Delta at 540 tons and they sold it at 118, and all the coal extracts was sold before the year end. The price of coal at year end was 124. And now we need to make sure we need to know how to account for it. So because I am a joint arrangement and we are now a joint operation, we will now at the end of the day add all of those revenue, the 460 times 120, the 540 times 118. See, we get 118.92 million. 40% of that goes to ABM. So ABM are entitled to 57,568 of the 118.92 million. So the difference between what they accounted for, their 460 times 120, that needs to be allocated now to the rest of the items, going either to government or either to the other entity, because I am only entitled to 47. If I ask you that from the perspective of Delta Extractives, again, we will say 40% they are entitled to the same amount, but less what they sold multiplied by their price, and the rest then goes to government. So make sure here there's no separate entity, so it's the joint operation. And I will bring in proportionately my assets and liabilities. So what does it mean in this question? The machine that ABM bought, for that they will bring in that machine into their books. The cost that they will pay, bring it into their books, and now the income that they sold, they will bring in 40% of the income, like we calculated here, saying that's their income. Okay, so I hope that makes sense. Okay. Then the joint venture, we already in essence discussed with the fact that we need to know or apply the equity method. So make sure in the parent separate financial statements, they can either decide to account for subsidiaries, associates, or joint ventures at either cost or at fair value according to IFRS 9, or I can use the equity method in my separate financial statements to account for joint ventures. Okay, and that's my decision that I have. So you need to see a subsidiary can be at cost or at fair value. Associate or joint venture can be at cost, fair value, or in my separate financial statements already at the equity method. And then when we consolidate, I need to see the joint venture and my associate needs to be on the equity method. So if it's not, if it was at cost, I need to apply the equity method. And that's what this slide tries and explains. Make sure you guys understand that part. And then I have like a extra part. This is also extra from the previous year's textbook. So the guys using the last year's one will not have this example, but they now tell me I have a 50% share in a joint venture. So now I see it's a separate entity, separate vehicle. And they tell me what I've paid. So if I start with the cost, 11 million. At the end of the day, the reserves was 44 million. At the date of acquisition, it was 18. Profit for the year of that joint venture, 6, and other comprehensive income 2. And now they ask me, the statement of financial position showed the investment. So you will see I will start with my cost, then add the post-acquisition profit, the part for the growth in retained earnings, that reserves, 50% of that. And also in the statement of profit and loss include now 50% of profit and loss and other comprehensive income separately. So I will add all of that. I will see there's a 24 plus then now, and remember this is at year end, so that already includes that reserve, the 44, those two items, profit and loss already. So that's my final balance of my investment in my joint venture, in my statement of financial position. And in my statement of profit and loss, I will have share of profit in joint venture, 3,000. And that's the same as an associate. And remember that this is already an after-tax figure. So make sure you guys understand it's the only item in my statement of profit and loss which is already after tax, included in profit before tax. The rest before tax, and then I have my income tax expense on each one of them. So make sure you understand that this is an after tax figure. Okay. And then my disclosure, other comprehensive income, I will just show them the share of other comprehensive income, 1,000 separately for that part. And again, work through your illustration 1. Go and make sure you understand how this links up with chapter 14, investments in associates in joint ventures, and make sure you understand the bigger picture. Then the last couple of minutes, we also need to be able to disclose interest in other entities. So this is related party disclosures, which I want you to be able to understand and disclose. So you need to make sure about disclosures for subsidiaries, joint arrangements, associates, and unconsolidated structured entities. So they give you a bit of guidance about the disclosure. You can work through each one of them and make sure you understand it. And to make sure you are able to apply it, go and look at question 11, required A2. Okay. And that's everything that we need to know about the session of today. So before we get to that, I'm just going to share this again, and then we will almost end off with a part which you will not find somewhere else. It's just my take on explaining everything that we've done today in a nutshell. Okay, so you need to see now, your thing that you need to take from this is there's already 3 types of entities that we've discussed. We have a parent subsidiary where there's control. So you need to know if IFRS 10 applies and if IFRS 3 applies when I acquire that share at the end of the day. Okay. You also need to see with IFRS 3, there's certain stages where I apply IFRS 3 in my separate financial statements. But the moment that there's control, the moment I have an equity share, IFRS 3 happens in my consolidated financial statements. And then that gives me guidance about what I transferred, what I paid for the share, gives me guidance about the net assets of that subsidiary, of how to calculate goodwill, non-controlling interest, etc. So it tells me the first initial recognition. Then any recognition thereafter is then IFRS 10 telling me how to account for growth. So it's only the initial recognition which is IFRS 3. And I need to see that link with IFRS 3 and IFRS 10. Okay. Then if we get to an associate where I have significant influence, it's IAS 28. So it's an associate or a joint venture. Associate straight equity method, and I apply that, and need to make sure that I have a profit share in associate and my investment in associate, and I need to understand the intergroup transactions there. Then the next part that we did is a joint arrangement, IFRS 11. And a joint arrangement, I need to see I have joint control. So there's 3 important definitions: control, significant influence, and joint control. And for joint control, I can now see it's either a joint operation or joint venture. A joint venture, the moment I classify it as it, I go back to IAS 28 and account for it as on the equity method as for an associate. But now my wording changed. Investment in joint venture, profit share in joint venture. Okay. And then the next one is the joint operation, and that's where it's not a separate entity, it's just an agreement. And now I need to bring in my assets and my liabilities, my income and expenses separately, proportionate, and that happens, and that's the important part that you need to realize. That part that I need to account happens in my separate financial statements. Yes, it will end up in the consolidated financial statements, but like for an associate on the equity method and the subsidiary on consolidation, which happens in my consolidated financial statements at the end, this happens in my separate financial statements, and it pulls through. So make sure you understand the differences there. And just to explain that, I'm just sharing this with you, and then I'll take any questions that you guys might have. So I'm just going to share my screen again, making sure you understand it. So bottom line, we have an overall eye view of the different entity types. And I just want to reiterate what we've mentioned already. Okay. So previously, most of you would have used this textbook to understand. You can still work through it. It will still help you at the end of the day. Group statements, volume 1 and 2. So make sure at the end of the day, you are able to see that there's 3 types that you need to consider. So control, IFRS 10, and that's a parent subsidiary. Associates, significant influence, and I need to see what that is. And then a joint arrangement, joint ventures, there's joint control, okay? So there's a diagram just explaining. So normally for subsidiary, like we said, more than 50%, we can assume that there's control, except if I give you something to address the definition of control. Okay. Significant influence, the same thing. 20% or more, significant influence. So it's less than 50, 20% or more. Okay. Significant influence. Unless I give you information about significant influence. Then it can be any percentage. Joint control, remember there, my share now needs to be unanimous consent to decide about something. So the percentage share doesn't matter. It is at the end of the day, unanimous consent. So normally we can assume that it's equal, that it's 50% for 2 entities. If it's 33.3%, but it can also be a 40 and a 60% share, and I still have joint control. So you're looking there for the wording unanimous consent. And anything except that is a normal investment, which I account for under financial instruments, IFRS 9, which you guys will do with Vrou vir jou nie. So just to put this into layman's terms, if we consolidate, and I want to bring this across, I'm seen as if I'm one. So my parent and subsidiary, everything in the statement of financial position, statement of profit and loss, statement of change in equity, and my notes, I add 100%. The parent plus the subsidiary, and I get a third set, a new one, the statement of financial position, statement of profit and loss, cash flow statements, I get a new set, a third one, the consolidated financial statements. In there, I need to be able to account for intergroup transactions, etc., etc. So question is, where do I start if I'm a parent subsidiary? I start off by consolidating, knowing at year end, what am I? So my question will always be from a group structure, what am I at year end? If I'm at year end a subsidiary, I know I will consolidate, and I know it's 100% of the parent, 100% of the subsidiary, plus or minus pro forma journals, which only happens in this consolidated financial statements. Right. And then after that, I need to take out the intercompany part because I'm seen as one. I can't transact with myself, and I need to create non-controlling interest. So I take out intercompany transactions and create the part that's not mine. And there's 3 periods, which is important. At acquisition date, since acquisition up until the beginning of the year, and the current year. And most people normally use this analysis of owner's equity here to guide them. Yes, you can use it. I just use my journals because my journals is applied in those 3 periods. And if I apply that, I can consolidate. So make sure you understand, right? And then I need to know which journals is affected by each one. So that's a parent subsidiary. The moment I am an associate, I use the equity method. So where do I start? If there's significant influence at year end, I know that I need to apply the equity method, which means it's cost plus growth, okay? So I only bring in what is now my part. So I only bring in investment in associate, profit share in associate, and my share of that profit, the share of the growth in retained earnings, the share of the profit in associate, and I need to remember about intergroup transactions, okay? Main thing that I want you to realize here, and I want to put out a disclosure there, a catch. So many times we forget to test to see whether we paid more or less. Okay, and I quickly just want to mention this. For an associate, I will never account for goodwill. Okay, why? Because if I paid more for my investment, the goodwill will already be in my investment. So think about it. Because we don't bring in 100% of the parent and the subsidiary, I only have one line item, investment in associate. Where will goodwill lie? In that investment in associate, in the cost if I paid more. And then I will have my growth. But I need to test to see if I paid less, because if I paid less than what my share was worth, I will have my cost, but my cost needs to represent at least what it is, the fair value in the active market. So if not, if I paid, for instance, let's say my 40% shares worth 4 million and I paid 3.5 million, that 500,000 is a gain on bargain purchase, which goes and lies within retained earnings or profit and loss, depending on which period I then draft my financial statements. And then it increased my cost. So that gain on bargain purchase, I will have debit, investment in associate or investment in joint venture, credit, gain on bargain purchase through P&L if it's in the current year. If I acquired that share a couple of years ago, it will be retained earnings that I created. And that's something that a lot of people normally miss with an associate. So never ever account for goodwill, but I always need to test to see if there was a gain on bargain purchase. And then that's an associate. Also, after my equity method, 3 periods, the date that I now need to see is at acquisition date, but what happens, it's only my cost, and I test for that gain on bargain purchase thing. Since acquisition up until the current year and the current year, and I need to know what journals affect them and see that if the parent and the associate sells, it looks different, so I need to understand that. And then lastly, joint arrangements, my partial consolidation. So the moment that I see that I am a joint venture, back to my associates principles, if I am a joint operation, I partially consolidate. And what does that mean? All my assets and liabilities, I bring in my share. So what do? If I have a 50% share, I would say all my assets times 50%, all my liabilities times 50%, all my income, all my expenses, and the growth in equity. So never my equity, never my share capital, but only the growth times my percentage share I bring in. And then accounting for intergroup transactions, because I bring in 50% of all assets, all liabilities, all income, all expenses, my intergroup transactions looks exactly like a parent subsidiary. The only thing is I multiply by my percentage. And that's what you guys need to see in a nutshell, the different types of entities, and make sure you understand it. And if it's difficult to work through your workbook, you can go back to Group Statements Volume 1 and 2. And it doesn't matter which year you studied. If you have this, you can use that part. You can go and find this online on the university's website as well, where you can get the latest version online and you can work through it. So if you don't know where to access it, please send me a WhatsApp and I will show you a short video, which I will then upload and show you where you can go and access it. You can't download it, but you are able to screen through that if you want this to assist you with preparing for groups. And that is everything in a nutshell for today's session. Okay, so it's quite a lot of information, quite a lot of things that you need to go and revise and revisit and make sure you understand it. And please don't hesitate to send me a WhatsApp and say, sir, I look now at a subsidiary and this is, I'm uncertain about this. I looked at an associate, I'm uncertain about this. Or joint ventures, I'm uncertain about this. Or consolidated cash flow statements, I don't understand it. So please go and work through those things and don't hesitate to send me any questions that you might have. And then there's 2 minutes or 3 minutes left for us to take questions about today's session. So any question, please unmute yourself, give me the question and let's get discussing that, making sure you have all the relevant information at your disposal.
I have a question.
Yes, Carmen.
I know that we awarded marks for application of principles and theories. So is it safe for me to say I don't have to provide paragraph references? I just need to apply the theory and that's it, that's enough? Or do I also need to state the paragraph reference, or that's not necessary? No, it's not necessary. So like you saw in those discussion questions that we had, you will see they didn't even refer back to IAS 28, okay? Yeah. So for completeness, so that you know what it's about, you will see, because we will provide to you before the test and the exam, some of last year's tests and exams, so that you can also see how that was done. Or in some of the assignments, you will see we say, according to IAS 28, but you will see that there's no marks for that definition. So you don't need to tell me IAS 28 paragraph 5b tells me the investment in associate is this. You will not get any marks for that. I want you to understand the principle and be able to apply it. So again, it doesn't need to be word for word. So like previously, you needed to, for when you were on the CA or the SciPy stream, give me the definition of an asset or joint control or control, word for word, exactly that, so that I am able to give you that mark for the theory and then the application. Now, if you apply, then I can derive from it that you mean, for instance, control that, or let's take joint control, where I said unanimous consent, and you say all parties need to agree on the decision, and you don't use unanimous consent, it means the same thing, and I can award you the mark. So you need to see it's a bit easier to apply than it would have been when you needed to give me that definition, because the definition you needed to have and then word for word try and apply that. Now I just want to see that you understand how it flows within one another. So yes, no paragraph numbers needs to be given, and it also then makes it a bit more open for interpretation. Instead of giving it word for word and then only you get the marks, I can ask you, wait, I understand from what your discussion is that you know what's going on, and I can award a mark. Okay, thank you. Pleasure. Just on that, I just want to make sure you guys understand. So it's not an open for all, discuss anything you like and you get the marks, okay? So it needs to be relevant. So you can't now come, for instance, if I talk about control, or let's say IFRS 3, and we talk about, I ask you to discuss whether it's a business, and you need to say, okay, there's supposed to be inputs, applied processes, and then from that I need to get benefits from the outputs. You can't now go and say there's 3 processes. Process A, B, and C, and expect me to get the mark. So it more or less needs to relate to what it's discussed, but it doesn't need to be word for word exactly what the definitions are. Okay. Any other questions?
I have a question.
Yes.
So I was looking at the questions in the activity workbook. They never tell you how the mark allocation works.
Yeah.
So you never know how to or what to give or how much to give or how much is one mark, for example.
Yeah, and that's the interesting part is you will also see if you go and when we get question papers from previous years and from the ACCA website, and we will do that with you guys in the summer school. It's very difficult because they just give the question and they say 10 marks and then they give you this paragraph. And then there's a lot of things and you need to now decide how that 10 marks is allocated. So from ACCA side, they're very open for interpretation about giving marks and things like that. For us, we will in a test or in an assignment try and give you guidance about how that mark will work at the end of the day. Okay, so you will need to, or you will see that after the 3 or assignments that you have, you will get more or less a feel for what we give marks at the end of the day. But in your activities, necessarily, they don't tell you there's 10 marks or 12 marks, but we will give you a bit of guidance through the test. And then in the summer school as well, we will give you a bit of guidance showing you prior year's tests and examinations, saying this is how we will then award marks, a half a mark for this or a full mark for applying this, so that you guys get a feel about how it will affect you this year specifically. But once you write the ACCA exam, it's open for interpretation. So you don't need to say everything that they have and you can get all the marks, or you can say a little bit more than what they have and you can still get the marks. So they're quite open for interpretation in the application and in the awarding of marks. So I think that's what makes it difficult for someone to show or prepare you exactly knowing, okay, this will count half a mark or this a full mark. So we will try and narrow it down so that we have that link moving over from SAIPA or SAICA or CIMA into ACCA and how they award those marks. But it's not always a clear cut. This will count a half a mark. Some memos you will see this will count a half a mark. Others you will see doesn't count a mark. So it's a little bit open, but we will always in a test or an exam tell you, for instance, that at discussion, it will be for 5 marks. And then my general guideline for the guys, if I apply anything, for anything that I've mentioned, I will not expect more than a half a mark. If I calculate, if it's a simple calculation, for instance, profit times a percentage share, that's a half a mark. But the moment I need to adjust for intergroup transactions, I will add for everything I need to do another half a mark. So that's more or less a guideline that I use when I interpret or draft a question. And that's something that you can always use when you try and answer a question as well. So instead of previously where you would have maybe gotten a half a mark for the definition and 1 mark for the application, or for every single part of a definition, 1 mark for the application, it might now mean for that entire definition of control, you will get 1 mark when you apply, instead of now having 3 or 4 marks lying there. But in that, we will give you guidance, telling you exactly what is expected of you. So by the end of this whole semester, you should more or less have an idea how the mark allocation. Does that give you a bit of ease of mind or some peace of mind or some certainty about what we will expect of you?
Yes, thank you.
Okay.
Can
Any
I do
other
something?
questions?
Can you hear me?
I can hear you, Shakina.
I don't know. I'm still confused. Like at the end of the year, the exam that we're gonna write, is it gonna be ACCA prepared? Who's gonna prepare it? I don't understand still.
Okay, so it's going to be based on the ACCA guidelines. So it will be asked in the way that you now have been being prepared through the activities and then the questions in your workbook and then prior tests and exams of ACCA, but we set it. So the memo that you will get will look a little bit different. It will not just be open and say there's 10 marks. We will show you on the memo then what the 10 marks is specifically given for, so that you are able to follow what it is. And the same will happen with the test that you have. So you will also see, I've already saw the assignment 1 and 2. I think assignment 1 was a bit more open for interpretation because you needed to do a bit of research. But assignment 2, you would have seen that memo, or you will see it once they upload the memo when everything is done. You will see that there's now specific guidelines saying a half a mark is awarded for this. So you will definitely know by the end of the year how the mark allocation will work, but we will use the guidelines for preparing the paper in the same structure as you would have for ACCA. And when you need to discuss something, it will be in the application that ACCA does, but we will give you guidelines about how the mark allocation works, because ACCA is very open and broad in the mark allocation. Does that give you more guidelines regarding that, Shakina?
Yes, thank you.
Pleasure. Any other questions? Okay, so again, I just want to reiterate the following. So please, if there's any questions, please ask, because on the time that we have, I don't ever will have enough time to go into the detail of every single thing. But it doesn't mean that you are not allowed to ask. So please don't hesitate to ask and say, so I'm struggling with this, can we maybe work through it, or whatever the case might be, or if you have a question, put it on that WhatsApp group and I can reply on the WhatsApp group. It might be able to answer questions for a lot of other students as well. And then please go and work through the things and the standards and make sure that you understand the principles of each one of these items. And should you wish to go into detail, go and say, sir, there's certain parts that I don't understand. Can you explain this a little bit more for me? And then I can maybe say, okay, let's arrange a session maybe with you guys somewhere that we can go into the details of IAS 28, for instance, if there's more than one person inquiring for that. But in the allocated time, I will hardly ever have time to go into every single detail of each one of the standards. Like you saw with myself, Prof. Niku and Mevrouw Fourie, there's 10 or 12 standards, or in this scenario, we have 6 standards which we needed to cover. And your homework now is to go and do research and prepare that and then come and ask the questions. Okay, so please take the time to go and work through that information, and don't let the lack of detail now make you think, okay, it's just going to be easy, because you will see if you go and work through those revision kit and work through those questions, and if we go to the exam questions, it's still of a higher level of understanding. It's not just simple things and mention something and you get marks. So you need to understand the detail. Okay, and I really hope the layout of what I've done today give you guidance about where you need to go and focus your time and where you need to go and study, and that the places where I tell you to go and work through that, you go and work through it, and if you have questions, come and ask them so that we can get that sorted ASAP, so that you're ready for the test, ready for the assignment, which assignment 3 will be based on groups and things like that. So make sure you are sufficiently prepared. From my side, good luck. I hope you enjoy the session. I hope you enjoy having lecturers from different lecturers as well, and that you find this insightful, and have a lovely evening. Thank you for joining me, and I will upload this as soon as it has converted. It will be uploaded onto eFundi. I've seen they've used different methods or different ways to apply it. I'm just going to make it available to you guys straight away on eFundi so that you have it, and that it's there at your disposal, so that you can just click on it and get the videos, etc. So I'm not going to try and waste your time to take you to different websites. It's just easier to navigate through that. So have a lovely evening and keep well.
Thank you. Bye.
Cheers.